Well, welcome everyone. Midway through May here. Thanks for jumping on with us for Mortgage Matters with Chris this week. And Chris, thanks so much for being here, chatting with us.
Oh, you're welcome.
This week, this was backed by popular demand to discuss some options, loan options for people who don't have regular income. So,
Yeah.
it's funny, and I had to look back on our records because I was like, surely we've talked about this before, but I don't know if we have. But you get asked all the time about, what do people do if they don't have normal W-2s and things like that. So appreciate you being here. You have over 25 years, I think 26 years, you've said, experience in the mortgage industry, and you and your team have combined significantly more than that. So you've done a lot of non-traditional type loans over the course of your time. So I think this is great for us to get kind of aggregate all this information on what so many people who kind of fall into this category, so they can find all of this in one spot here. So we're going to answer all the questions related to bank statement and I believe it's called non-QM loans. Is that the official term for that?
Yeah, non-qualified mortgage program. So outside of the box, not your typical or traditional conventional loans, which would fall under a Fannie Mae or Freddie Mac, or a government loan, which would be loans with HUD, FHA, USDA, VA loans, those types of loan programs that require income documentation, such as W-2s, tax returns, pay stubs. With these non-traditional type of programs, we're talking about how can we come up with alternative documentation to show income. And Mindy, and those of you out there listening, probably about at least 20% of my portfolio is geared towards self-employed borrowers. A lot of times, when you're self-employed, you take advantage of the tax laws, and you, at the end of the day, have multiple write-offs. So, you may make the money and be able to afford a nice home that's $500,000, but on paper, after I look at your tax returns, your adjusted net income is somewhere around 50,000, and that puts you in a position where you don't qualify for anything in this market. However, that's not really where you stand as far as your income is concerned.
20% is a pretty big margin. 20% of your clientele's in the loans that you do, that's pretty significant. I think it's interesting today, maybe this is why we've gotten so many questions as of lately in this post-pandemic world. We know that so many people went out on their own, after big companies laid off a bunch of regular W-2 employees, a lot of people went out on their own. And because, you're just going to sit at home and do nothing? So they made their own way. And it seems like we have more self-employed people or people who don't make a standard W-2 than we've had, at least in a long time. So very, very relevant here. So,
Yes. Yeah.
Chris, let's dive in. The conventional way that we think of, not conventional loan, but like the conventional wisdom to get a mortgage, someone thinks, I have to have my W-2, my normal tax return from that, and then I have to be at that job for 2 years. So a person who owns their own business or has gone out on their own doesn't have most of that, right?
Right.
So with this bank statement loan, what's the alternative? What are you looking for in terms of documentation for people who don't have the W-2? What do they need instead?
So there's two different ways to do the bank statement program. One, it would be based on 12 months of bank statements. Now, we have different ways to do this. We can use personal bank statements or business bank statements. So if we go with we can go 12 months worth of those bank statements or 24 months. If we go as far as the 24-month bank statement, sometimes it's a little bit more advantageous for our client because the rate may be a little bit better because we're showing more documentation and we're showing more income. Now, typically how it works, and this is where it gets a little tricky, so I want to try to explain this in a way that is very easily understandable. So we'll take 50%, almost like we would if we showed what you made for income as a W-2 person, I'll use 50% of your income to support your debt. Okay. We'll do the same thing with bank statements. So let's say, for example, you're a small business owner and you deposit all of your money into, you own, let's say you own you're an electrician. You own a little electrician. You're an electrician in a little electrical company, and you bring in around $200,000 a year into your bank statements. Well, I'll be able to use 50% of that as your income, right? $100,000. So now I just base it on $100,000, which, technically you got $16,000. We just got to keep everything under the $8,000, 50% of that. All your bills, your new mortgage payment, which would include your principal and interest, your taxes, insurance, PMI, if there's PMI, or what we have there. And we can do this with as little as 10% down. So with the bank statement programs, you can do them for refinances, cash out refinances, or purchases. And all that would be required is a 10% down. Earnest money deposit. Well, not earnest money deposit, but just you would have to put 10% down to get your financing. Now, there are some little, and I don't want to get too deep into this and confuse people, but let's just say there's two types of businesses, okay? Let's give you the electrician, like we talked about, right? He's self-employed. He's got to go out. Sometimes for jobs, he's got to go buy material. He's got to go buy wiring. He's got to go buy face plates. He's got to buy all this stuff. So there's a little bit more expenses. He's got people that work for him. So out of that $200,000, he might be paying out somebody. Some of that money might be going out to employees, product, materials, and things like that. So that's why we're going to the 50%. Also, you have another self-employed person. Let's use a realtor, for example. Realtors don't have that much expenses, right? So you may bring $250,000 into your business as your 1099, and well, you keep 80% of it, right? So how would we get around that? So say you only bring in, as a realtor, you have the electrician over here bringing in 200,000, right? But we know he keeps about 50% because he's got employees, he's got trucks, he's got this, he's got all this other stuff. And we got a realtor over here who brings in about 100,000. They close, a couple deals a month, and, they make a good, honest living at $100,000 or $120,000 a year. And that would be hard if I say you can only use 50% of those bank statements. Well, in those cases, if I have a letter from your CPA that states, listen, at the end of the day, we're only going to be using, expenses are 80% of this or 90%. And, all their expenses typically are is like phone bill, this or that. There's no employees. There's no real cost of the business. Then in that case, then we will be able to work with that number based on 70%, 80%, or whatever it comes up to, whatever that CPA is saying. So we look at it case by case. So I don't want to just say on this podcast here that it's 50% cut and dry. It's really not 50. It's 50% out of the gate if there's no CPA that's getting involved that's going to help with writing us a letter of what the earned income is based on after expenses. So that being said, think of it as you bringing me 12 months of bank statements in your little business or your big business, whatever it is, and you deposit $10,000 a month. Average. So I take the average, I add up all the deposits over the last 12 months, and then I divide it by 12. And that's what we use for income. And then based on however your business runs, I'll decide, or I won't decide, between what the accountant gives us back and our underwriter will decide what will actually allow you to use up to, whether it's 50%, 60%, 70%, 80% of those deposits as your income. Does that make sense?
That does. So for clarification, let's say someone has, can someone expect the process to be different? Say they're a sole proprietor and everything's under the Social Security number versus they're an LLC. Are there some differences they can kind of expect in terms of that?
No, because any self-employed borrower, so you must have at least 50 to do these loans, you have to be self-employed. You must have at least 50%, in most cases, 50% ownership in the business. I like to say 50%. Sometimes, we see some exceptions with some of the other investors that we use could be a little less, but for a rule of thumb is 50% at least. Sole proprietorship, partnerships, LLCs, or corporations. All right. And the validation required of the borrower's percentage of ownership needs to be provided by, a CPA or an attorney, an enrolled agent, or their tax preparer, someone like that. That way, it's requires validation from a neutral third party that business has been in operation for a minimum of 2 years. So you need to be self-employed for at least 2 years of that time. So as long as you have a business license showing that, or a letter from a CPA, which again is that third party, or an attorney and a enrolled agent, like I said, or tax preparer, Secretary of State filing, I just need to show proof that you've been self-employed for 2 years, and then we're good to go. And then all you do is you're going to submit those bank statements to me. Whether some businesses are so small that they just run the business as a sole proprietorship and runs right through their personal bank account. So I take the personal bank accounts. Now, if you're a business and you're an LLC and you run most of your business through your business accounts and you take very little into your personal account and most of it's run through your business, well, then I'm going to take the 12 months or 24 months of your business bank statements. And we can look at, if you could provide 24 months, it's going to just be a little bit better in rate for you. So, because we're just providing more documentation, and it just shows that there's a little bit more breadth to your income rather than just a 12-month look back.
So a lot of people who are just starting up businesses, or maybe they started one up 2-3 years ago, for that first 1, maybe 2 years, they claimed a loss because, as we know, it's not easy to start a business.
Right.
And so showing a loss on paper is a pretty normal part of starting a business. So let's say that they've been in business 2 years. The first year they showed a loss. This year they showed a profit. Is that going to harm them, or is that going to change
It will.
things?
It does, because a lot of times what they'll do is they'll blend the income. So they'll take the average of the last 2 incomes. So if you're going full documentation, meaning you're going to provide 2 years of tax returns. And 1 year you did horrible, 1 year you did great. The only time I've seen like an exception on a bad year is with COVID. So there was like a lot of grace, if you will, for a lot of people that were self-employed through COVID that lost a lot of income. They made some exceptions during that time, but the rule of thumb on that would be, an average of the last 2 years of income. So if you made 100 grand this year, but last year you only made 50, I'm going to probably go off for 75,000, and that may not help you qualify for the type of home that you realistically could afford. So an alternative program like a bank statement program would do great. And it also works for people that are 1099. So don't think of just bank statements, because that's if you're self-employed, but there's a lot of let's say contractors who get paid by companies as a 1099, which is like the same as a bank statement. I can go off of 1099s as well and use 50% of the income. So if you're the type, you have the type of business that you sit from home and you're a subcontractor for a company, maybe you work for multiple companies in a couple of years, but you always have work lined up. We've done it that way as well. So I think it's important for people to know that these are programs, and why I think that these programs are so fantastic is, let's look at it. Let's look at it this way. Say you show 50,000 or whatever, 50, 40,000 at the end of the day, your adjusted net, that's all you show. You can't really afford anything. And typically on something like that, you pay in like $5,000, $10,000 a year in taxes. Now, to qualify for the loan, you need to show 2 years of this like really good income. So you say, you know what? I'm going to go amend my taxes because I made that money. I want that awesome rate, conventional rate in the 5s or the 6s, whatever it is. I don't want 7.5 or 8 or whatever these programs have, because the rate is a little bit higher. So I want to walk through this because I think it's very important to understand this, not to be penny wise and dollar dumb. And what I mean by that is you're going to go, I've had people say, I'm going to go and amend my taxes and I'm going to show, what do I need to show? Because I make it. I'm just not going to use my deductions, I guess. I mean, I should be able to use my deductions, but if I didn't use all these deductions and actually kept the money, I could probably have afforded a lot more of a house. And I say, okay, well, yeah, you can go, you can obviously show, I mean, your bank statements show that you brought in 150,000. So we know you really did. But you had these deductions. You're going to end up paying what, 25% in taxes, up to 25% of tax on 100 grand. So you're going to pay an extra $30,000 times two to qualify for a rate that may be a percent or two half better, saving you 200 or 300 bucks a month. So now that I painted that picture for you, let's do that math. So now you just paid 40, 50, 60,000 in taxes to save yourself 300 bucks a month. To me, that doesn't make a lot of sense, because I'd rather see myself pay, an extra $2,000, $3,000 a year in a mortgage payment than go out and throw away $50,000 to save that money. Does that make sense, Mindy?
50,000 to the government, no less.
Yeah, I mean, it's just, you know what? You're gonna be penalized. You're taking advantage of the tax rules and the tax laws, and you're using your write-offs and your deductions. So, to a person that's lending, I want you guys to think about this. Think about it from the lender's point of view, the guy that's going to lend you the money, the company or the bank, the investor that's going to lend you out the money. They're taking a risk. I mean, you're just showing bank statements of money coming in. You have all these expenses. There's going to be a cost associated with the risk, right? And it's a small cost compared to what you would pay if you're going to go pay or not take advantage of the deductions that you could use to save yourself a couple $100 a month.
And so, it's a very small cost compared to staying in
small costs. And that's why I do a lot of these loans. I work with a lot of whether they're property investors or they're self-employed, and everybody I talk to, I have to have this conversation with them because they want the prime rates at where they are. But once they understand and once they get, well, listen, I mean, you're going to pay one way or another, but this way you're going to actually pay a lot less than you would if you didn't take the deductions that you're able to, and then you claim it as income, because you're going to pay a lot into taxes. I mean, this is a small price to pay at the end of the day, and it gets you in a home. And if your business changes at some point to where you're making so much money that you're actually, with the write-offs, making a substantial amount of money to where you're claiming it and you're paying in that money, then good, refinance your mortgage into a lower rate, and you can always do that when that time comes.
So they're not stuck with that. Chris, can you talk through one more scenario, because I feel like this is a very common scenario especially in our area here. A lot of couples, they'll have one person who has a standard job and they got a W-2, and the one person who's self-employed. What would you do in that situation so that someone knows, like, if they're thinking of stepping out of renting, stepping into their first or maybe next home, just moved to the area, has their business that they started up 2-3 years ago when they moved here, spouse is W-2. Obviously, every situation's different, but what's one path that could look like?
Well, I mean, that's unique in a sense, because we know all the money. So say those bank statements were coming to us, right? I got all your bank statements. I'm going to deduct the deposits of the payroll checks. I'm going to keep that separate from what the income is from the bank statements, from the self-employed income. And then I'll add the W-2 income back into it. So, you're still using the bank, the investor is fine, because I'm showing that it's income. I'm still using it all. It's, and it's just one's W-2 income and one's self-employed income. We're just not going to double count it, if that makes sense. So we're not going to say, oh, this guy, it's all getting deposited in the bank. We're just going to say, okay, this portion of the income is 50,000 from the job, and the business does 100,000. So the total income between the household is 150,000.
So no one has to feel like they can only go on the W-2 or they can only go on the business. Like you have,
Well, you're going to go through one of these programs if one of you has a business. So
yeah,
one of you has a business and you're not proving that income, and that's a big portion of the income that we're using. Fortunately, you have a solution. You can do a program like a non-qualified mortgage program, like a bank statement program. However, you're going to have to go that route no matter what.
yeah.
You're going to just have to go this route, even though a portion of the income is W-2. So,
I think
uh,
it's a misconception that if one spouse is self-employed, that there's nothing they can do to contribute. It just has to be on the spouse with the W-2. And so what you're telling us here is that's not the case. Um,
no,
for
I'm going to use
yeah,
deposits. So, I mean, we're just going to separate where it's coming from.
yeah.
It's coming,
Well,
again, it's household income.
Well, obviously every situation's different, and you and your team, does consultations for individualized for each person, so that they can see what is the best scenario for their case and getting them into their next home. So I guess at the end of the day, uh, you're still going to be having a lot of these conversations, but this is really good because I think this answers a lot of the questions that you get a lot
Correct.
people who just because it's not a normal thing. Most people, we talk about conventional loans a lot. Most people don't talk about bank statement loans, so it's almost like a veiled mystery. So
Correct. And just to take that last question one step further, I mean, we can also, like I said, the income documented using the personal bank statements, it can be combined with that other source of income, and including if that self-employed person has two incomes, meaning some of it's W-2'd and some of it's, self-employed. I can use both of those, even if it's the one person. There's a lot of people that may have, a job that they've had on the side. Like, so say, for example, you do a part-time job, W-2'd, but your big portion of your income comes from your self-employed business. As long as you've had that other income, as long as you had the income for 2 years on both sides, we can do it. We can combine that income and use it. So, um, it's a great option for those that think, you know what, I tried to do this and I couldn't qualify for a mortgage. These programs have been around for pretty much as long as I've been doing this business. There might have been a little bit of a period of time where you didn't see these programs after '08 for a little bit. There was a little bit of, everybody backed off. People weren't doing anything, but these programs have been back around for, a handful of years now, at least, to say the least. We've been doing a lot of them. So again, you're going to have, you can't have a bad credit score. There's credit score requirements that kind of go along with these types of programs. And, you're going to have to, I think we can go as low as even a 660 on these programs. But then again, your loan to value may be, 60%. You have to put 40% down. So there are little things that kind of go in, and I don't want to do that because we want to end this on time. But that's why it's important for you guys to give us a call. Another topic I think we should talk about next week is I've been getting a lot of questions on debt service coverage loans. That's for our investor community. How do those work? How can I, qualify for that? Which means it's not going on their income per se. It's going based on the property's income that the property generates a month, and you have to back it up with good credit. However, we're not going to use your supporting income. We're going to use the property's income to support the debt. So that's another great program for that kind of same non-qualified mortgage program that people are asking for, especially here in Florida. A lot of people buy investment properties down here. I had a handful of closings this month with these programs. So definitely want to educate you. Call me anytime. Love to have a conversation with you, whether you're one of our realtor partners or you're a client that's listening in, or a potential client, I should say, or just someone that's like more interested in hearing more or getting more information about these loan programs. We're really here to help, and we want to be able to share all that we can with you.
yes. Well, we will, all of this is aggregated into a blog post. We now have it in video and we now have it in podcast form as well. So for those who want to rewatch this or maybe want to listen or read it later, We're going to link all that onto here. And of course, if you find that, please like and subscribe us on YouTube, podcast. Check us out on mortgagedreams.com, which is where the blog posts for all this will be. And we'll be back next week with kind of the follow-up, or I guess the next step of this, like you said, on those debt service loans, and what that means for people around here. So, Chris,
Excellent.
thank you for the time today. Thanks for
Thank you,
answering
Wendy.
these
Appreciate
burning
it.
questions.
Hope you guys enjoyed, and look forward to hearing from you all. Thank you.
Yes, awesome. Enjoy your weekend, everyone.
Bye, Mindy.